Navigating the investment seas, understanding the concept of risk tolerance. In the realm of investments, where uncertainty looms like a shadow, the concept of risk tolerance emerges as a guiding beacon for investors seeking to chart a course through the tumultuous seas of financial markets. This crucial element shapes investment strategies, influences asset allocation decisions, and ultimately determines the suitability of an investment portfolio to an individual's or institution's risk appetite. To truly grasp the intricacies of risk tolerance, one must embark on a journey through the defining factors, psychological nuances, and practical implications that underscore this fundamental concept. Defining risk tolerance. At its core, risk tolerance is the degree of variability or uncertainty that an investor can withstand in the pursuit of financial goals. It encapsulates a multifaceted spectrum, ranging from risk-averse individuals who prioritize capital preservation to risk-tolerant investors willing to embrace volatility for higher returns. Understanding one's risk tolerance involves a comprehensive evaluation of financial objectives, time horizon, and most importantly, the individual's psychological disposition towards risk. The risk-return conundrum. Investing inherently involves a trade-off between risk and return. Generally, higher potential returns come hand in hand with increased volatility and the likelihood of greater losses. Investors with a high risk tolerance acknowledge and accept this trade-off, willing to weather market fluctuations in exchange for the prospect of superior returns. Conversely, risk-averse investors gravitate towards safer, lower-return assets, prioritizing the preservation of capital over the pursuit of outsized gains. For instance, consider two investors contemplating an investment in a diversified portfolio that includes both stocks and bonds. Investor A, with a high risk tolerance, may allocate a larger portion of the portfolio to stocks, anticipating the potential for higher returns despite the accompanying volatility. In contrast, Investor B, with a lower risk tolerance, might opt for a more conservative allocation, emphasizing bonds to mitigate potential losses and prioritize stability. Psychological factors at play. Risk tolerance is not solely a numerical assessment but is deeply intertwined with psychological factors that shape an individual's attitude towards uncertainty. Behavioral finance recognizes that investors may exhibit emotional responses to market fluctuations, and these reactions can influence decision-making. Emotional biases such as loss aversion, where the fear of losses outweighs the desire for gains, can impact risk tolerance and lead to suboptimal investment decisions. Consider a scenario where the stock market experiences a sudden downturn. An investor with a low risk tolerance may succumb to fear, prompting a hasty decision to sell stocks at a loss to avoid further declines. In contrast, an investor with a higher risk tolerance may view the market downturn as a buying opportunity, confident in the potential for a market rebound. Understanding and managing these psychological nuances is integral to aligning investment strategies with one's risk tolerance. Assessing risk tolerance. Several methods exist to assess an individual's or institution's risk tolerance, ranging from simple questionnaires to more comprehensive financial planning tools. These assessments typically delve into factors such as investment time horizon, financial goals, income stability, and the ability to withstand short-term market fluctuations. A thorough understanding of one's risk tolerance enables the construction of a diversified portfolio that aligns with individual preferences and financial objectives. For example, a young investor with a long time horizon and ambitious financial goals may find that a more aggressive, equity-heavy portfolio is suitable, leveraging the power of compounding and accepting the associated volatility. In contrast, a retiree living on a fixed income may opt for a more conservative portfolio, prioritizing stability and income generation while minimizing exposure to market swings. Dynamic nature of risk tolerance. Crucially, risk tolerance is not a static trait but evolves over time in response to changing life circumstances, financial goals, and market experiences. Life events such as marriage, the birth of a child, or retirement can significantly impact an individual's risk tolerance. Similarly, exposure to market cycles, economic downturns, or windfall gains may prompt a reassessment of risk appetite. Consider an investor who, after experiencing a market downturn early in their investing journey, develops a heightened aversion to risk. Over time, as financial knowledge deepens and confidence grows, this investor may reassess their risk tolerance and consider a more diversified and growth-oriented portfolio. Recognizing the dynamic nature of risk tolerance is imperative for maintaining a resilient investment strategy that adapts to evolving circumstances. Practical implications for portfolio construction. Risk tolerance serves as a cornerstone in the construction of well-balanced investment portfolios. Asset allocation, the strategic distribution of investments across different asset classes, is a key determinant of portfolio risk and return. Investors with a higher risk tolerance may allocate a larger proportion to equities, harnessing the potential for capital appreciation. Meanwhile, risk-averse investors may emphasize fixed-income securities to mitigate the impact of market volatility. For instance, a moderate risk-tolerance investor might opt for a balanced portfolio comprising a mix of stocks and bonds. This diversified approach seeks to capture the growth potential of equities while providing a buffer against market downturns through the stability of fixed-income assets. Such a portfolio construction reflects a nuanced understanding of risk tolerance, aligning investment choices with the individual's comfort level with uncertainty. Conclusion. In the dynamic landscape of investments, where the winds of market forces can shift abruptly, risk tolerance emerges as a guiding principle, steering investors through the undulating seas of financial markets. Its significance transcends numerical assessments, delving into the realms of psychology, behavior, and the ever-changing dynamics of life. Recognizing one's risk tolerance is not merely a theoretical exercise but a practical and dynamic tool that shapes investment strategies, informs decision-making, and ultimately defines the resilience of an investment portfolio in the face of uncertainty. As investors navigate the complexities of financial markets, the compass of risk tolerance serves as a steadfast guide, empowering them to make informed choices that align with their financial objectives and withstand the tempests of market volatility.